Hey everyone, welcome back to Lunch at the Market. We're glad to have you. You may have noticed that I've started to get a little scruffy. We're actually going to enter the Pittsburgh Penguins Beardathon. That's right. If you're not an NHL fan, then you'll be surprised to learn that every year people that like hockey support their teams because a long time ago in the NHL, and I need to look up the origin, but basically you don't shave as long as your team's in the playoffs. And so when you lose, you shave. And so that's why you may notice by the time a team hoists the Stanley Cup, most of the guys on the team, they're sporting nice big beards. And that's just tradition in the NHL. So the Pittsburgh Penguins, sponsored by Supercuts, actually has a beardathon where you actually take a picture of your face at the beginning of playoffs, and then people raise money for charity. It's for Mario Lemieux's foundation that helps certain blood diseases and some children's hospitals. So it's a great cause. It's fun because you don't have to shave, and if you listen to our episode with Guy Adami on America's Favorite Traders, then you know that Guy and I are people that just like to shave as infrequently as possible. Actually, speaking of people on America's Favorite Traders and shaving, Pete Najarian's episode is now available on America's Favorite Traders. And I know you love Pete Najarian. Why? Because the guy has several thousand followers. And those people are real people, okay? Because the bots, they get deleted periodically. So you look like you have a lot of followers, and then you come back in over the weekend and like 20 of them are gone. Most of the times it's not because they defollowed you. It's because those were little Twitter bots, and they just delete them. Anyway, I digress. So we got the beard going. You know what else we have going on today? Goldman Sachs. We have Goldman Sachs going on today. Actually, I should say we have Goldman Sachs going down today, which is, of course, when we step in and buy and sell put spreads. I know, you could probably do this show instead of me, huh? Well, if you want to audition for us, you should @mention us on Twitter if you want to audition for Lunch in the Market. Otherwise, @mention us on Twitter and ask us a comment. Like, for instance, @NARAYAP. And I apologize if that's your name. I would do a terrible job pronouncing that. So they wanted to know about Goldman Sachs. What if it falls further? That is certainly the risk, our friend. That is certainly the risk. But how we trade at Magnum Opus Financial is we get a stock that we would like to buy. Okay, we do all the homework on it. We listen to the conference calls. We check out their balance sheet. We get a company that we really like. Okay, Goldman Sachs is a company that we really like. They mint money. I mean, you'd think they have their own printing press right next to Ben Bernanke's in the basement of the Feds, but they don't. It's because they're really good at what they do. Despite the fact that they are hated by a lot of people, some may say they're the squid on the face of America. Whatever. These guys are great at making profits. JP Morgan just reported their quarter, and they talked about how their trading revenue was excellent. Karen Feinerman on last night's Fast Money pointed out that their trading revenue was, in fact, very surprisingly more than she expected to see. This should bode well for shops that are heavy in trading, like Goldman Sachs, like Morgan Stanley, those guys, maybe even Bank of America's Merrill Lynch arm. Wouldn't that be a nice surprise? But Goldman Sachs is your pure play on that. And so rather than plop down, $16,000 for 100 shares of Goldman Sachs, we would rather sell put spreads, which is in effect you're leaning the same direction, meaning you want the stock to go up or at least do nothing at all. In fact, we're short the 150, 145 put spread, so the stock could actually decline another X%, right? Another $5 a share, and we'd still be okay. Stock's trading around 155 and change right now. We've got a $5 cushion. Today's whoosh down was like $4. I mean, it's a huge, huge move to the downside in one day on Goldman Sachs. Again, when that happens, usually volatility expands. And so just by selling the premium at the time where vol's high, and you can tell vol's high when you look at the Bollinger Bands. Okay, so you put the Bollinger Bands on your charts, and you'll see those Bollinger Bands on the top and the bottom of the price action. When big moves like today happen, the Bollinger Bands explode, indicating that options prices have increased significantly. That's the times when we like to be sellers of options. So at NARAYAP, you're correct. Goldman Sachs could go down further. And if you remember back to 2009, it did. And then it did again and again. We don't think it's 2009. In fact, Goldman stock has really been held down as of late because basically all the financials have a lower multiple. Remember, the multiple is the number of times earnings that somebody's willing to pay, which determines the stock price. So in Goldman Sachs, you got, say, $13 in trailing earnings per share. You multiply that by 11.8, and then you get the stock's current price. So Goldman trades at 11 PE, and they're really doing a great job. Even if you give the stock a 12 PE or a 12.5 PE, which is under the historical average of the S&P, which is 14.17, the stock gets a lot higher than it is right here. So after today's big whoosh down, and it looks like the stock is trading up a little bit, maybe 156. Anyway, you've got some cushion. It was a great trade this morning. We sold a lot of those spreads. It should work out for us well. If the stock does happen to trade down, well, then we roll it either out, depending on how badly it's broken, or we roll it down and out if we really feel like we need to get down to the 145, 140. So that's how we're going to trade that. We had some other comments on the Twitter stream from @PNAR asking us about our U.S. Steel position. We used to be long the 45-55 in the money call spread. That call spread also used to be in the money. It's not anymore, and so we took it off. Basically, once it got down to, I don't know, say a 10% loss, we lost $100 or so. We took it off, and we're primarily playing it now through selling the 52.5 50 put spread. We tried that this month. It got broke. We rolled that out on the calendar down and out to July, so we're now short the July 50-47 put spreads. It's essentially the same size spread. We didn't have to increase our position size. We just rolled down and out on the calendar. It was a really nice trade. And then we've got some more next month in May. We're short the 52.5 50s. We'll kind of see how we trade through earnings season. If we get a lot of these producers of commodities or assemblers of steel like Nucor, AK Steel, US Steel, if we start to see that they report okay and the earnings are nice and they tell a good story, then we might be able to just leave those May 52.5 50 short put spreads. For now, at PNAR, and again, if that's your name, we love that you wrote in, and I appreciate that. You're going to have to forgive us on the pronunciation. So we also had @Brit Cruz from StockTwits ask us about Target, telling us that Target was going to launch somewhere around 200 new stores in Canada. I don't care. Okay, let me just reiterate this for everybody that might be new to the show. I don't like Target, I don't like Walmart, and I really don't like Costco either. Look, in these low margin businesses, why play in that space when you have companies that have margins in the high teens or the 20s or the 30%? Okay, we'd rather play the Rackspace, NTAP, Riverbed, F5, these guys that are in the forward economy. Old line retailers, look, they're having to compete more and more with guys like Amazon and Walmart.com. I mean, even Walmart has to compete with Walmart.com. Okay, so the reality is that I don't care what Walmart says it's going to do. I don't care what Target says it's going to do, unless they just do something so transformational that they basically are not the same company anymore, then I might get behind it. But as long as they're Walmart and Target and Costco, and all they do is sell goods to the consumer, and they try to beat each other out, offer the lowest price, really, does that sound like a good business model that you want to invest in? I'm not saying don't shop there. Please, save yourself some money. Go shop there, but don't buy their stock, right? Buy a pair of shoes at Walmart, but don't buy a stock of Walmart. Buy a dress at Target, but don't buy the stock of Target, because they are trying to compete on lower prices, and that sounds like a terrible business model if you're a shareholder. We want higher prices, higher margins. Okay? All right. So thanks for joining us again today. Don't forget, mention us on Twitter or leave comments in the comments section. Don't forget to subscribe to our YouTube channel if you don't already, and you can always watch all the Lunch at the Market episodes when they're live and the back episodes by going to magnumopusfinancial.com/lunch. We'll see you there. Thanks for tuning in today. Have a great day, and we will see you tomorrow. Don't forget to go on iTunes, search for America's Favorite Traders, and get Pete Najarian's iTunes episode. It's fantastic.